Okay. So thank you very much, Jason, and thank you very much for the opportunity to speak at this virtual conference. And hello, everyone. So let me first very quickly introduce myself and my professional background, and then our company, Quantpedia, the encyclopedia of quantitative trading strategies. And then I will talk about how traders can use academic research as an inspiration for developing new trading strategies. Let's start. So my name is Radovan Vojtko, and I'm former systematic portfolio manager. In the past, I worked for data asset management company, which is the biggest asset management company in the Slovak Republic in the European Union. It has over 2.5 billion euros of assets under management. I personally manage over 300 million in several quantitative funds. These funds were focused mainly on multi-asset, managed futures, trend following, global technical asset allocation, market timing, and volatility trading. And what's Quantpedia? So now let me tell you a few words about Quantpedia. It will be very fast, and then we will move to main part of the presentation. So Quantpedia exists since 2011, and I'm CEO since 2015. What's our goal? We are a quant research company. Our mission is to turn financial academic research into a more user-friendly form to help anyone interested in algo quant trading and systematic investing. We are continually building a database of ideas for systematic trading strategies, which are extracted out of academic research papers. Our research covers all main asset classes such as equities, bonds, commodities, currencies, or cryptocurrencies. How we do it, or how does it work? We are continually building a database of ideas and investment strategies which are extracted out of academic research papers. So we read a lot of papers from research portals, financial journals, universities, etc. And we select the best and write short reviews so that our users can faster understand the main subjects of these papers. Plus, we extract performance, risk characteristics, trading rules in plain language. And users then can screen our database, they can learn from research, and they can look for inspiration. The subset of strategies contains our sample backtests, replications, together with equity curves, trading statistics, source code, etc. So users can continue exploration. Or they can just check if our sample performance matches the in-sample info from the source research paper. The reason for that is that we want to help our clients to look for inspiration, but also to check if the research papers is correctly written and if the things which are written in the research papers are working. Okay, in this presentation, I will try to explain the advantages of using academic research in quant algo trading. So I will try to answer a few common questions which are related to academic research and mainly its role in quant trading. So I will give you one very short and simple example of a less common trading strategy which can be extracted out of academic research, so you can see how it can work basically. Okay. So the first question, who publishes academic research? There are tens of thousands of research papers which are related to algo trading and systematic investing and which are published every year. Most of the research is produced by academia, professors, PhDs at universities, but the significant number of papers are published by professionals, asset management companies, brokerage houses, etc. A lot of the research can be easily found via Google Scholar, or there are various specialized databases like SSRM.com and so on. Now, why would somebody publish a working strategy? So if you are an academic, then it's simple. A lot of academics are very curious, so they are doing research in a pursuit of knowledge. They want to show that they have bright ideas and they want to let other people know about it. So it's also a way to climb an academic career ladder. So it's a possibility to start a side business as a consultant for some hedge fund or start a fund on their own. And why are the asset management companies publishing working trading strategies? Because they want to raise more assets. So there there was a very strong shift in transparency after 2008, and a lot of hedge funds publish a lot of academic research to show their expertise. So it's a way how to gain the trust of pension and sovereign funds and family offices. So you want to show knowledge so that other people will understand that you understand what they are doing and you will be able to raise knowledge. Okay, another common question. So once published, will strategy stop working? So there are a lot of papers or research papers which answer this common question, and the answer is no. So strategy usually doesn't vanish. Yeah, yes, there is a decrease in profitability after anomaly or strategy is published, which is logical, but the returns do not weaken instantly. So it's not easy to arbitrage market anomalies. So most of the anomalies, they have a time varying return. So the fair part of the return is preserved, as arbitrage is not risk-free, and fair part of the return is preserved also after the paper, after the strategy is published. And also out-of-sample return of published strategies can be attractive. So for example, I highlighted one paper. We can take a look on a paper which is written by Han and Yang, which is called Decomposing the Factor Momentum. And as we can see in the following chart, the buy and hold strategy of published anomalies is profitable. So once you take the anomalies, you will take a look when they were published, and you will, and in case you will hypothetically invest only in anomalies which were published. So there is a decrease in performance compared to the past performance which is in the paper, but the anomalies are still profitable. Moreover, the decrease in strategy's performance could be avoided by early adopting the ideas from the working papers. So it's possible to rotate among multiple anomalies or multiple factors, trying to pick the best performers, trying to pick the best strategy and include this set of anomalies and strategies in a diversified portfolio. So for example, as an inspiration, again, I just highlight the paper written by Arnold Clemens Kalesnik, which is called Factor Momentum, and which is taking the anomalies which were published, picking the best performers and investing only the best into the best one. Okay, the question. So do investors mimic or copy ideas out of academic research completely and without the change? No, it's not the case, not at all. So academic research is usually used only as a source of inspiration. So in practice, every fund, every portfolio manager, every investor implement ideas differently. So no company uses strategies as they are described in a research paper. Each investor always uses different definition of factor strategies, different trading rules, mix them together differently to suit the better needs. So it may look like the strategy is very well known, but it may not be crowded because it may be used very, very differently in different companies, and there is still space to use it. And the most important question for everybody, so how can I or how can we use the academic research in our trading? So we can gain a lot of knowledge out of the research. It will give us understanding of what different types of trading strategies exist and examples of them. So we can learn something more, something new. We can gain access to the reasoning of the large hedge funds and asset management companies. So we can better understand how professionals structure their portfolios, what are the important things, what are not important things, how they are building the portfolios, and so on. And it will also give us ideas for our own strategies. So we can use academic research as an inspiration for the development of new investment and trading strategies. And so the best way is to give an example. So let us show the usage of academic research in trading. So the best course of action is to try fundamentally understand anomalies which are described in academic research, and to then explore their functioning besides the original scope of the research paper. So I have prepared one very, very short example of a trading strategy which is extracted out of academic research. And then I will show you how we can port that idea into another investment universe. And the strategy which I've prepared for you is, the goal of the example is to explore the skewness effect. So what is the skewness? Skewness is the tendency of assets, or the skewness effect is the tendency of assets with the lowest skewness, the negative skewness, to outperform assets with the highest skewness, with the positive skewness. I will give you one example. So the skewness ratio represents the extent to which the distribution of curve is distorted. So in a data set, so if a data set, for example, daily performance of an asset, I don't know, some commodity, is symmetrically distributed, the value of skewness is 0. In the case where the majority of data set values is concentrated on the left side, we talk about the positive skewness. So what does it mean? We have a lot of small losses or a lot of the performance around the 0 and few big winners. On the other hand, when the majority of dataset values is concentrated on the right side, we talk about the negative skewness. So what does it mean? We have a lot of small gains and a lot of the performance around 0 and few big losses. And now the average value of dataset is higher than the mean value in the case of negative skewness. And the best example of skewness effect in the trading is a research paper from Fernandez Perez and his team, which is called the skewness of commodity futures returns. So the team around Fernandez Perez, they checked the skewness in returns distribution for a group of 27 commodities on the futures. Based on the findings, the researchers proposed the trading strategy of going long on commodities futures with the lowest skewness and going short on commodities futures with the highest skewness. So clearly the strategy is profitable, but it has one more additional feature which is very favorable, and I will show you in the next slide. Our research suggests that the performance of the equity market, represented by the S&P 500 index, is negatively correlated with the performance of the skewness strategy. So therefore, if the equity market performs badly, the skewness strategy should be profitable. So if you look up the worst months of S&P 500 index, which are the blue bars, and compare them with the performance of the strategy, orange bars, we will see the performance of the suggested strategies is at most times positive, and therefore the investor will be able to hedge his equity portfolio. Now, the logical question is, why are negatively skewed commodities outperforming the positively skewed? The reason for that is behavioral, and it's also written in a research paper. So basically, it means that investors are looking for lottery tickets. So investors usually prefer assets which are positively skewed. So they usually prefer assets which have very, very big gains. And it means that these assets are usually they are very expensive. And in case we are shorting these positively skewed assets and buying the negatively skewed assets, there is a difference in performance. And now, how we can build on the original idea of using the skewness ratio to sort commodities. So once we understand how it works, we understand the paper, we understand the reason for that, the interesting course of action is to try to change, for example, the investment universe from futures to ETFs. So we tried it for this presentation. We picked the 14 most liquid individual commodity ETFs, like ETF for US oil, for natural gas, gold, silver, platinum, palladium, and so on. So 14 most liquid individual commodity ETFs. And we build the trading strategy with the simple rules of going long the most negatively skewed ETFs, going short the most positively skewed ETFs. Backtest starts in 2011 due to we need to have a lot of ETFs, so we need to have enough ETFs in a sample, and goes until 2020. And it seems that the anomaly is present not only in commodity futures, but we can trade it also in liquid ETFs. And now, thank you for attention. So this was very, very quick presentation, and I hope you liked it. You liked this short presentation, and I hope that I was able to motivate you to incorporate academic research into your process of finding new ideas for trading strategies and to learn something new. And in case you have any questions, I'm open to answer them. Right now we have a few minutes. Feel free to ask.
So yeah, no one has sent in a question so far. Oh, someone has sent in a question. So can you see the questions, Radovan?
Okay, so what is our relationship with QuantConnect? We are independent companies. We are using QuantConnect only as a tool to be able to create the auto sample backtests, and that's all. So that's all basically. It's faster than to do it on our own computer and then publish pictures out of into the web page. So that's all. Okay, great job for the second okay, that's not my question. Okay, can you explain the chart showing the effect of publishing research on the returns of strategy? Okay, I can return back to the slide. Let me check. Okay, so here is the slide. Okay, now let's get it back. I need to create a space so I can read. Okay, so what we are looking at is the red line, which is buy and hold of published strategies. So what is this paper showing is that the paper is talking. The main idea of the paper is we will start trading in 1990, and we will trade only the strategies which were published. And once the strategy is published, we will start to trade it. If there are 10 strategies, we equally weight our portfolio between 10 strategies. If there are 15, then equally weight between 15. If there are 20 published, equally weighted into 20. Until the year 2017 or 18, 21 factors were published in the most known journals. And once you started this strategy, which is built on top of other factors, the red one, you can see that even that the strategies are published, so everybody knows about them, and you are using them, your performance is still positive out of sample, and it's fine. So basically, that's the reason, or that's what I was trying to show. Do you work with an institutional investors? So there's another question. Yes, we have a lot of institutional investors. So Quantpedia has like 50-50 split in our clients. 50% are institutional and 50% are retail clients. Do you see a lot of uses of machine learning as a trading strategies? Yes, I would say there is definitely a shift, and a lot of the academics are using machine learning. But not only machine learning, alternative data are also I would say, something which is very popular among academics. What's the monthly subscription cost? We have 3 months and 1 year subscription cost. 3 months are $299, and 12 months are $499. What is the most promising category of algorithms in your mind, and what is the least promising category? That's a very tricky question. What is the most promising? I would say the most is not that there is most promising category of algorithms. There is a most promising way how to think about the algorithm. So the most promising way is to understand how strategy is working and to use it somewhere where nobody else was thinking about. So I will give you one example. So we have like this commodity trading strategy in Skivnes, and which is using 27 most popular commodities. The problem is that they are using most popular commodities. Now let's try to port this strategy and not use them on commodities, but let's use them on an additional 20 commodities which are not so popular. I mean, there are futures on butter, there are futures on rice, there are futures and so on, which are less popular, and usually the strategy is better, has a better performance when you are using it on investment universe, which is not so popular. So that's positive. And what is the least promising category? The least promising is when you are basically following the crowd. So when you are not using, you are simply taking what is written in the paper and using it with exactly the same rules and stuff like that. Okay. How much interest is there in crypto strategies? Are there any that are used to work in equities that may work in crypto? So the first question, there is still some interest in cryptos, but it's much, much lower than it was 2 or 3 years ago. And if there is any that is used in that worked in equities and may work in crypto, yes, like usual factors, momentum factor, reversal, valuation, it works also in crypto. You must use different type of valuations. So, for example, in the equities, you use price to book, price to earnings. In cryptos, you must use something different. So, price to, I don't know, something different, but it's working also for crypto. But, at the moment, as I said, the most popular academic topic is alternative data and machine learning. Okay, the last. I think these are probably nearly all of the questions. I don't know, Jason, do you see any? Yeah.
So it's coming up on 9:05. So any other questions, feel free to send them in and I'll make a note of them. And if I can send them to Radovan later, but we're going to transition to our next presentation. Originally, we were thinking about a 5-minute break now, but as we'll go with the 5-minute break. So we'll do a 5-minute break now, and then at 9:10 a.m. we will transition into Rémy's presentation. So yes.
Okay. Thank you for your attention.
Right. Thank you again for the presentation, Radovan, and everyone, please check out Quantpedia. I know I've used them for a couple of years now. They're very, very helpful and interesting.
Thank you very much. I appreciate it.